watching Stockwatch. I'm Nader Kuman. Joining me to unpack your stock-related questions tonight are Grant Nader from Benguela Global Fund Managers and Ricus Reeders from PSG Hole in Ruimsig. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag Stockwatch. Thank you so much for your time, gents. A very, very good day for the resources. And Tingela is just flying high today, up by over 8%. We have Exaro 7%, Kumba Iron Ore 6%. Yeah, it seems that, has everyone participated in this rally, Ricus, in this commodities rally today?
It looks like it. I think what triggered it was the release of manufacturing production numbers earlier today, where first of all, it's surprised to the upside, and specifically as far as iron and ferrous metals and coal and that kind of number is concerned. So I think it just added a little bit of impetus to a commodity cycle, which is just, in my opinion, probably basing or close to turning.
It's quite interesting that you're saying close or certain to turning, and that's obviously to the upside. Is there still no certainty that it is sustainably rising, Grant?
You know, commodities are never certain, but you can just tell by looking at lead indicators. You can look at the price action. You can look at, you know, the problem is if you're looking at iron ore, it looks like nothing's going on. If you look at copper, you can see this action, yes, and then the story is it's all about tariffs. But copper's been going up long before tariffs.
Yeah.
If you look at gold, gold is leading, silver has followed, copper has followed, and typically commodities do tend to move in the same direction, not always at the same time. And so I'm not surprised to see the energy stocks catching a bid, and you know, and some of the others like the iron ore, even though those prices haven't yet played the same game, the stocks are starting to lead what people think is coming next. And so yeah, it's not a guarantee, but when the money stacks up and you're bumping up against cost curves on the bottom,
yeah.
So there's the limited supply coming online and those kind of things, then you tend to see, look at the PGMs, they were bumbling along for about 12, 18 months. Cost, you know, broad sideways channel, but you know, they've broken out. So I think there's a good chance some other commodities follow suit.
Okay. I'm being begged to talk about Talcom. And of course, as we're seeing there in the top 5 major moves on the JSE, Talcom snuck in there in the middle. That's up almost 7% on the day. Ricus, we've seen quite a steady rise in Talcom today and also in the last, a lot of weeks actually. And it's actually quite interesting because we're seeing just big moves on Talcom. Every day when we're seeing it's just a rally after rally after rally. And I'm just wondering, because at this point I would have thought that maybe there would have been a little bit of a cooling off, but it just seems that buying activity is just continuing rapidly. What do you make of that move?
Yeah, I think the market sentiment towards Talcom has definitely turned positive, and at the moment it's price momentum driving it upwards, and I won't be surprised if it goes and retests the 60 rand level, which is sort of a previous 52-week high. So how much of the good news is in the price, I don't know, but certainly momentum continues to stay with the trend, and in that sense I probably won't be buying into it following this very sharp rally. But certainly on any kind of pullback, considering the change not only in opinion, but I think also in the company's operations.
Yeah.
It's gone from being a complete left behind to something which I think is investable at the right price.
It's quite interesting what Ricus said. He's a little bit cautious of going in at this level, saying that if there's a pullback, sure, he can go in. But for a person who has sold their shares, who had sold their shares about a month ago on Talcom, they're wondering if they should get back in at the current price, Grant. What would you say?
Well, they still would have done well if they sold it a month ago. They missed this last big move, but they've done well. I'm the first to admit that Talcom has surprised me as well, in terms of its delivery. They've done actually a really good job. And as Rick has said, they actually are investable now, which for a long time I don't think they were for many larger managers. Whether I would buy it here, I wouldn't buy it here because there is definitely a lot in the price. And as well as they've turned the business around, there's definitely priced for the turnaround. The question is here, can they drive growth from here in a meaningful way to support the next leg up? And I would rather wait. I'd rather be a little patient. You don't have to squeeze every drop out of the lemon. There are other opportunities out there. There's a lot of cheap stocks in the market at this point in time.
All right. Well, let us go into. This is a very interesting one. This is on the hardware retailers. Where is it? Now I've lost it. But anyway, the viewer was basically asking about the hardware retailers and particularly Cash Build. If it is a sizzling, dripping roast, what are the prospects in this sector? And actually, Ricus, we did see, when was it, yesterday, Ital surging by about 5-6%. Is there appetite for this sector at the moment, and why?
No, cash flow is usually cyclical, and it's really dependent on the local economic cycle, which at the moment is not cycling. I mean, prospects still remain dim, and I think cash flow will do what it can in order to maintain costs, but I can't see a huge rally in revenue all of a sudden supporting the price, and the margins will remain under pressure for various reasons. As with every other retailer, so no, I don't think it's a dripping roast. Its time will come, but for the moment, to me, it looks as if we're sitting sideways at best.
Yeah, I mean, it's quite interesting because I actually thought the viewer would be asking about Ital more than Cash Build. Grant, what do you think about that sector as a whole? But also, would you be kind of making would there be a difference between Ital and Cash Build, distinction between the two?
Now, look, they've both been very well-run businesses for a long time. But Rick has hit the nail on the head. Economically, it's a difficult place for them to be in. They've even still got, I think they arguably still have the COVID hangover that's tailing off now. But now you're tailing off into a very lackluster economy. The two pots should have helped them. I haven't seen that in the earnings. So if guys were going to cash in a little lump sum and spend it on their houses, it hasn't happened yet. So that's a bigger ticket item than buying a T-shirt. So you're going to see the sales pick up in the discretionary retailer before you see it in these durables. And I think you need to wait and see some turnaround in the SA macro. I am more constructive on the SA macro. I think if we see further rate cuts, which we will, I think we'll see that if the GNU stays together, and a number of things go away, commodity cycle, etc., you could see opportunity here, and they could pay you over the next couple of years. I don't think there's any imminent pickup in these cyclical sectors. Certainly not these ones.
It's very interesting that you talk about the COVID hangover because there were certain, specifically the home improvement sector was the one that really, really rallied a lot during COVID. And you even saw the furniture store Lewis gaining a lot of interest from investors. And I actually read, it was an article yesterday or 2 days ago saying that I think since COVID, Lewis's share price has gone up about 400%, if I'm not mistaken. And it's quite weird because they all went like this, the Ital, Cash Build and Lewis, and then they just diverged at some point. Ricus, I'm wondering then, because they're all part of that home improvement industry, and I'm wondering then why the others went left field and the others like Lewis actually carried on.
Well, I think the market woke up to Lewis having been a deep value situation for a very, very, very long time. And don't forget, they make most of the money out of finance, not actually selling spanners and cement and tile. So I think Lewis was a re-rating as a company. But, as far as that sector of the market is concerned, you can just take a look at Judaica. It had its results a week or so ago. The retail side was uninspiring. And if if that's the case for Hideko, I can't see why either Ital, which is really the end product after you start building something, or Cashbuild, which is what you would go and shop at if you start a project, would be the exception.
Okay. Lewis, before we go to the break, Grant, I mean, would this be a counter that you're looking at? Because it seems to present defensiveness.
Lewis has actually been a really good operator, and they've benefited from the struggling economy because, as Rick has said, most of the money has been made on finance. They're operating in a very well-run credit book. They're running high loans, a high loan book. They're selling all through credit, their furniture and the like. And they made a few acquisitions that have been good as well. And then, of course, they've got a high debt ratio. I mean, but they're pricing for it, so they're earning high rates of return. There's a level of sort of let's call it micro lending. Maybe that's the wrong word, but it's a high risk, high return model they're running. It's working for them. They seem to know what they're doing, and they've executed really well since COVID. And despite this share price run, the share is trading on, I think, less than 6 times earnings. So it's not something we would buy because we have some question marks perhaps around quality, and also it's not that liquid. But I think it's actually a very good little business, and I think it continues to deliver year after year.
All right, gents, let's get to more questions. All right. Firstly, very, very fascinating question here. We have heard of the Mag 7, but have you heard of the Terrific 10? And the viewer goes on to kind of compare each of these Chinese counters to the US tech counters. So I'll just go through the list of the Terrific 10: Alibaba, Tencent, is it Meituan, Xiaomi, JD.com, NetEase, Baidu, BYD, Geely, and SMIC. And the question is, how do I get exposure to the Asian market? Terrific 10 to be specific. Firstly, let's go through that kind of comparison between the Mag 10 and the Terrific 10, Grant.
All right, so the Mag 7 we all know as the tech titans in the US, but the Terrific 10, listening to that list, obviously some of them are well known, but there's also the likes of Xiaomi, which is moving into auto electric vehicles. You've got Geely, you've got BYD. Those are also vehicles. So I think there's already a concentration. I think BYD is doing a good job. Xiaomi seems to be doing something interesting. I don't know if the quality of that Terrific 10 is anywhere near the level of the Mag 7, although I think some of those stocks are high quality. Alibaba, Tencent, I think those are good businesses. Meituan, I think is not bad either. If you want exposure to China, I don't know of an ETF specifically focusing on that. There probably is one, but you can get the K-Web, which is the internet ETF, which touches Alibaba, Tencent, JD, and those sort of that AI flavor type of thing. And
what
then there's
K-Web?
also K-Web, that's the Crane Shares ETF.
Okay.
And that's basically the Chinese internet player ETF. So it doesn't have those auto companies. I know you can get the Satrix China, which probably incorporates all of those companies, but more than just 10. So you won't get the concentration perhaps. I mean, I think you just need to look around. It's not hard to find. If you've got a foreign account, I guarantee you'll find an ETF on the Terrific 10. If you have to invest out of South Africa in a local brokerage, there's probably maybe 2 entrances into China through ETF routes.
Yeah. Okay. Well, this is a very interesting one because, I mean, a lot of people tell us that the US tech market is pretty frothy and that there are opportunities in China where some of these stocks are dripping rose because of how cheap they are. Ricus, how would you be making that comparison between the US Mag 7 and the Chinese Terrific 10?
Okay, can I just start with avenues for investing? Signia has a fund that is concentrated on Chinese new development, if I'm not mistaken. That's local. On my side, from offshore portfolios, I've invested in the Invesco China Tech Fund, which includes most of what you've said there. As far as well, let's say I've traded into that fund.
Okay.
Because I'm not investing into that fund. Because that suggests to what the problem is with China tech. The Chinese government, in other words, Xi Jinping, because he is the government, has spent a lot of effort in throwing money at his local tech sector, with mixed results. That being said, they're still sitting with a huge local market with lots of potential, and specifically participating in what is still a very positive sentiment towards tech. So I think money can be made, but I am extremely aware of what can happen at any time, either with Xi Jinping's policies or with Xi Jinping himself.
Yeah.
There is rumors, if you take a look at the geopolitical situation within China, where he's starting to be under pressure. He has almost completely reorganized his own military because that's the one guy, or that's the one group of people in the country you don't want against you. So he's been getting rid of people that might possibly threaten him. And the fact that he sees that as a danger means his position is not as secure as can be. And with him gone, you've got turmoil in China, because whatever happens, whether he expires or whether his premiership expires, change is not going to be easy in that country. So I'm very wary of being stuck in Chinese tech, although I do see in the short term very good opportunity in that sector and in the country itself.
Okay. Yeah, very, very interesting points made there. Let's come back home and talk about Pick n Pay and Boxer. Pick n Pay's 60% shareholding in Boxer is worth more than Pick n Pay's market cap. Please explain, Grant.
So it's very common to have a holding company discount. So if you look at Remgro, for example, the discount to its underlying holdings has stretched out to 40% earlier this year. So Pick n Pay is effectively a holding company of Boxer.
Yeah.
But then, of course, the fact that they have their own business that's been recapitalized, that they've got a lot of money to try and rebuild, should be adding that incremental value and should have closed that gap. And as we were saying offline earlier, it does tell you the market's not yet convinced that turnaround strategy is gaining traction. I haven't seen evidence of it yet. I've seen opposite evidence. They've been pulling back on a lot of their execution, especially around ASAP and the online offering. They're obviously not winning there. And while they're doing that, SPAR's doing deals with Uber, and ShopRite continues to steamroll everybody. So I think there's a longer way to go than many realize, but perhaps that's not the case. Maybe they do realize it, and that's why you're seeing the discount. So when you start seeing evidence of a genuine turnaround and return to profitability, or at least a path to that, you'll see that gap close, and there's the opportunity for you if you buy that story.
Interesting. I mean, Ricus, where would you be seeing opportunity here? Some people would maybe say Pick n Pay because of the room that does exist for a turnaround, or Boxer because of the continuation of their solid performance.
Well, if you like Boxer, excuse me. If you like Boxer, go and buy Boxer. You don't have to go and buy Pick n Pay to go and buy Boxer. And I'm very glad Grant mentioned turnarounds, because think about Pick n Pay and SPAR. Both companies are in a turnaround situation after a couple of disastrous years. I think SPAR is further along the line. Not that I would be investing in either one of those two, because I want to see real proof of a turnaround, as Grant has also said. But it is a consideration. If you are looking at companies in a turnaround situation, I would always go for the one that's further along the road, that at least have stopped the bleeding, or stop being as bad as they were a year ago. And in that sense, if somebody forced me to either choose between Pick n Pay, I would probably say, well, SPAR's further along the road. A little bit more of a track record of things starting to move in the right direction.
All right. Well, gents, let us get to your stock picks for today. Grant, where are you finding opportunity?
Right, I'm pushing the boat out a little bit. I'm saying I would buy Glencore at these levels. It's looking very cheap. It's trading less than 7 times earnings with commodities. That can be misleading. But they've got their coal assets, which are, coal is at a depressed price. I think you've got copper and cobalt. They've got a really nice metals portfolio outside of the coal. And then they've got their marketing or trading arm, which basically monetizes volatility across the commodity portfolio that they have. So that's like a third profit generator. And I think things are going to go their way, and I think you're getting a really attractive entry point here. It is a riskier play because it is a commodity, but you're not only pegging your hat on one commodity, so you've got a bit of diversification. I think there's that new management there, which I like. I think they're a bit more focused on shareholder returns. And so I think there's an opportunity here for, if this commodity cycle gathers steam, your upside far outweighs your downside from these levels.
All right. Ricus, let us get to your stock pick for today.
It's fast-moving commodities logistics group CA Sales. Recently, smallish company, recently listed. Fairly good track record since 2011. Dividend growth of about 17%, like that in a small company. Earnings growth can probably be a little bit up and down, but let's say 20-15% on average. Trading at a price earnings of about 14. With 10%, 15% growth, you'll get that down to 12, which is quite cheap compared to its competitors on an international basis, which is about at an 18 PE. Obviously, there is a risk because they're basically biggest businesses in Botswana, Zimbabwe is 20, also a bit of South Africa. Interesting one. They've just gone into Kenya, so they're opening up the East African market as well. And what I like about the fact that even though they are in what one consider a risky geography, with sanctions and trade wars and whatever, SADC has got to decide whether, if we can't export to the US, we should start exporting to our neighboring countries. And any simplification in the various border controls and everything that stops your truck from moving across the border will have a huge effect on CA Sales costs and operations. If your truck doesn't have to stand 4 hours at a border post but only 2 hours, imagine the cost saving you can get from that.
All right. Well, thank you so much for your time and for your analysis today, gents. Really, really appreciate it. That is all for tonight's Stock Watch. Thanks to our guest, Grant Nader from Benguela Global Fund Managers and Ricus Reeders from PSG Hole in Ruimsig. Up next, the close. Stay watching.